B.O.L.I, it sounds like something that you need to see the doctor for, something that you might want to go get checked out and get that antibiotic. But what if you learn that it's one of the most popular strategies used by the most powerful financial systems in the world? Now, you might not have heard, or it's not very commonplace to hear about bank-owned life insurance. But the big banks sure do, because they've quietly amassed or they've quietly quadrupled the amount of bank-owned life insurance that they have purchased and owned in the last 11 years alone. Today, we're going to pull back the curtain on this. We're going to pull back the curtain on why banks and the banking system is storing their tier one capital and how they're incentivizing or really creating golden handcuffs for their employees. And so if the most trusted financial institutions where we store our money today is using this, maybe, maybe there's a secret here. Maybe there's something that we want to explore. So when we jump in today, we're going to bring back the traditional banking model to the you and me level. So let's dive in. Think about this. Banks are in what business? They're in the business of making money. No two ways about it. The most profitable business in the world. We always talk about how we all have to be in two businesses, the business of making money and B, the business of banking. And they're not making decisions lightly. They have a team. They have a highly qualified, specialized team of financial experts, legal experts, attorneys, risk managers that are dedicated to maximizing the profit and minimizing the risk. So why are banks choosing permanent life insurance for the primary storage of their tier one capital? And let's break that down. Let's talk about what is tier one capital, Jason. Pop it in the chat below if you know. Tier one capital is the most secure and essential money that the bank has. It is the way that the banks can promise to keep the bank stable and running even in tough times. It is their emergency fund. It is their safety net. Is what their tier one money is. And they're required legally to keep a certain amount of tier one money in safe, protected places. And this is why permanent whole life has become such a financial instrument for the banks. And so if you've ever listened to Gary Brecka of 10X Health, I wasn't really very aware of Gary until pretty recently when I go into my feeds on social media and I see this guy's face and I'm like, wow, he looks like he's in shape. He's got 10X Health on his shirt. I wonder who he is because I do all kinds of biohacking, whether it's plunging or red light therapy or having red lights in a room before bed because of our systems to sleep. And Gary fascinated me a couple weeks ago in a video that I saw in the Nelson Nash Institute. Gary was talking about permanent whole life insurance, and then I found out that Gary worked in the actuarial department for 20 years. And Gary talked about how in science, we only want to have one variable. And when he talked about how the whole life, mutually owned whole life companies were so solvent, Gary started talking about, well, yeah, the actuarial department, actuarial science, has been around for a couple hundred years, and we're always advancing in our science. And we can look at someone's profile after they get their height, weight, blood, urine, doctor reports, all those things, and we can family history, and we can tell you pretty eerily, right, when you're going to no longer be here, when you're going to graduate, when you're going to die. And it would drive Gary crazy because Gary could use his superpower of knowing when we're going to die. He could even tell us why we were going to die, what month, how, would it be painful and slow, preventable? And Gary couldn't do anything about it. So one day, I believe he told his girlfriend at the time, like, hey, I don't want to do this anymore. I want to focus on longevity. Now, let me ask you, even though he was helping the insurance companies with the most profitable business, actually the stable business in the world, and he was helping them dial in that one variable so they knew, the insurance companies knew what? They knew how long that we would be paying our premium deposits from the time we start to the time that they knew we were going to die. They knew how they could go and invest that money in safe places to get a return to be able to pay the guarantees and stay profitable every year for the hundreds of years that they've been in business. While at the same time in 2008, 2009, Gary mentioned that, well, hey, banks had 364 failures in 2 years. In 2 years. Because of how they practice and use their money because of the fractional banking system. And he said there was zero whole life companies that had went bankrupt in that same time period. That's fascinating. And so because whole life insurance companies only focus on the one variable, they have mastered this so well that their financial models are nearly bulletproof. And when we look at the fractional banking problem, look at that stat. That stat is staggering in this FDIC. Now, if you look at the FDIC, you see this when you walk into the bank and you see that it's insuring, because it's insurance, $250,000 of your money. Now, if you're someone who has millions of dollars in the bank, hopefully you have it like in shell game in multiple banks. But with this FDIC, look at that number. They are insuring currently 1.25% of all of the depositors' money that has been put in there. And the depositors have deposited $17.9 trillion as of January 12th of 2025. Do you hear that number? 179 trillion. And they only have $133.1 billion in reserve. So let's put that in perspective. If a financial crisis were to hit today, tomorrow, in the near future, the FDIC can actually only cover 1.25% of all deposits. Now, on the other side, to be devil's advocate, on the other side, someone who supports the FDIC would say, well, yeah, Jason, but they have never failed to pay a claim. I'm going to show you this Hall of Shame list where billions upon billions, almost $1 trillion for just 4 banks alone, were bailed out. And a lot of that was bailout money, and the money was insured by the FDIC. Now, whether all those people are paid or not, I don't know. I didn't go that deep into the research, but I'm sure we could find out. But just know that right now, with the 17.9 trillion that we have deposited, you and me have deposited, only 133 billion is actually protected, 1.25%. And they're going to say, oh, by 2026, we'll get to the 1.35% we aim for. Why are we aiming for 1.35%? How did someone come up with that math? So if the banks are keeping all their tier one money, the money that has to be their safety net in the specially engineered whole life, why should we keep our money in the banks if the banks aren't keeping their money in the banks? Does that make sense? And before I dive into this American Banker Hall of Shame, if you're new here, go ahead and help spread the message by subscribing. Smash the like button. And as my son Connor says, ring the little blue bell. And it will alert you to all the new content so you can keep learning and doing the 3 things we talk about, the 3 T's: train, test, and teach. Training is filling our mind with knowledge. Testing is applying the knowledge, because without the application, it's pretty useless. And finally, turning around and teaching others, because that's where the magic starts. So let's look at this American Banker Hall of Shame. Let's go through, and this shocked me. It was kind of fun going through this, but I'm going to give you the top 4. Number 1 was the Washington Mutual Bank. The Washington Mutual Bank, $307 billion failed in 2008 during that housing bubble crisis, okay? Now, number 2 surprised me. Number 2 I wasn't even aware of until I was doing this research. It is the First Republic Bank in California, and they failed to the tune of $229 billion. Billion dollars. That is a lot of dimp. We're at $500 billion already, and that's only 2 banks. Next is the Silicon Valley Bank, which is $209 billion. I talk about this one a lot, almost daily, at the beginning of 2023. Now, these 3 banks at 2, 3, and 4 on our list, they are all within a few months of each other. What's fascinating, back in the 2008, when that Washington Mutual Bank in Nevada failed, when they went bankrupt, after everything was said and done, guess who swooped in and saved the day and kept it going? The JP Morgan Chase Group. Guess whose island, right? You guys might have heard this mentioned before. Guess whose island back in 1910 in Georgia, where there was 6 of the richest men that that represented 25% of all the wealth in the world met, and a few years later, the Federal Reserve was born. You might have heard the creature of Jekyll Island. Well, JP Morgan even profits even when there's a $307 billion bailout. I don't know the total connection there, but it just takes logic. We're just using what Nelson tells us to do, which is our thinker. We're just thinking about the things. And number four, the fourth bank is a signature bank in New York. And that was 109 billion. So between those four banks, you had almost $1 trillion, 800 million. So now you might have all seen this before. This might be new to you, but no matter what, this is the interactive, very interactive portion of this training. Grab a pen and paper, draw a cross or a T on your paper, and use your crown pencil or pen and write bank in the top left, policy in the top right. Under bank, you're going to write the word liquidity or liquid. Under policy, you're going to write the same thing. What's your definition of liquid? Pop it in the chat below. Share with each other. My definition is it's not locked up in money prison. You don't have to pay a penalty to use your money, and you don't have stipulations. You can just get it when you need it, okay? It's accessible. If you have a high yield savings, if you have a money market on your sheet, write down what it is, whether it's 3.88, 3.5, 4%. I'm just giving you the 0.07 that the conventional banks are paying the majority of folks unless they have their money in a high yield. Under policy, you have 3.25%. Now, this is just one. I like to use specific examples. This is one of 5 of the mutually owned dividend paying whole life companies that we work with, and they're guaranteeing contractually 3.25%. Your money can never do worse than that once you've made your premium deposit. And this is guaranteed. It's the first guarantee of 2. That's why Brent Kessler says no one's ever mad at us, because we're always offering guarantees. And really, the only way that this could go wrong, which is one of the questions you're thinking, because you think this is too good to be true, I know it. Otherwise, we would have talked already. But as you're thinking that, just know that the biggest culprit, the biggest thing that could go wrong is you. So just know that that is the truth in this. This is really about you taking that agency and ownership of this. Under bank, you have it taxable. All that growth, even in a high yield or money market, it is taxable growth. Under policy, it's tax-free or tax advantage, tax-free growth, tax-free loans, tax-free distribution. Under the bank, you have unstable. I showed you the banking hall of shame and the failures that only 4 of them equaled $800 billion. Unstable, meaning that they practice fractional banking, meaning if there's a run on the money, it's not really protected. Banks only keep 10%. They create money out of thin air every day, and that's how they make more money, loaning us our money that we put there. Under policy, stability. We vet the companies thoroughly that we work with. All the mutually owned dividend paying whole life companies, they've all been profitable for over 100 years, and every year they've been in business. They're all A+ rated or better, meaning out of 15 ratings, they're in the top 2, and they have great customer service, and they support infinite banking. And most importantly, they're the ones that we use personally. When you talk to us, we're only writing with companies, working with companies that we know, like, and understand, and have relationships with them. And that is why it is a stable environment. In this example, it's 148 years of consecutive profitability. So in uncertain economic times, remember, where does tier 1 money have to go? Someplace where it's safe and secure. And now next, we have not protected. In a bank, someone gets hurt, you're an entrepreneur. If you're an entrepreneur, say I below, or just write it down. If you're an entrepreneur, guess what? If someone gets hurt in your business, on a property, doing some work, whatnot, a good attorney, the ones you see on the billboards, the personal injury attorneys, can come and have some liens and judgment against your capital in a regular old bank. Banks know this too, don't they? But in a policy, it's protected against liens and judgment in every state. Now, some states are fully protected, and others, like California and New York, they're not, but they're more protected than they would be in the bank. So far, if you're just looking at the left side versus the right side, if you ask your kid or ask the 5th grader, Just find a random fifth grader at a bus stop and make sure somebody's with you when you do this, but just ask them, hey, look at my chart. If you had money to store somewhere, which side would you be storing your money on? They're all going to say the right side. You know, the right side. If you forget your right and left, just do this, and the one that makes an L is your left side. That's my line coach taught me in high school. And so it's protected against liens and judgment. And you have all of the right side living benefits there. And then under bank, you have no death benefit. Under policy, you have a tax-free death benefit, which is what? It is the second guarantee. And if people say you can't buy your legacy, that is not true. So if you're looking at this chart and you're telling the truth and you compare the left to the right side and you're advising a bank, where would you tell them to keep their tier one money? You would tell them to keep their tier one money on the right side. And banks listened. They said, that is sage advice, wise advice. We're going to do that. And now they have $225 billion worth of this stuff. They have 4x the amount they have since 2011. Please think for yourself. Please go look up what I'm saying. That number I pulled was from quarter 2 of 2024, 225 billion. When I started teaching this chart less than a year and a half ago, it was $180 billion. Now that we see where banks should store their money, let's talk about why banks do store their money in B.O.L.I. Again, it's not a disease we have to go to the doctor for. This is bank-owned life insurance. It's an acronym. So banks have figured out that permanent whole life insurance offers advantages that other vehicles just don't have and that their own system does not. Let's look at some of these. The tax advantages, right? They have the tax-free nature where the money's taxed now when we know what the tax rate is, and it grows tax-free forever. And the death benefit's tax-free. This is an incentive for them. And then you have the guaranteed growth. I talked about two guarantees. You have the guaranteed contractual growth. You may get dividends, and since they've been profitable every year, the banks are probably banking on that they're going to give a dividend. We can't promise that, but it seems pretty likely. And then you also have the guaranteed death benefit. And then you have the liquidity. Remember, it's not locked up in financial prison. It's not locked up in some kind of asset that you can't use. For cash value, they have access to the money. And then the one that we're going to focus on a little bit here next is for the employee benefits for the golden handcuffs, which is a great way to not only incentivize your employees, but you're tethering them to their desk for the longest period of time that they will accept. Now let's go into the golden handcuffs a little bit. I talked about this on a recent podcast. The golden handcuffs, it refers to financial incentives that really make it painful. It's like a carrot, like you got that carrot on a stick in front of the employee, but it makes it really painful for that executive who's very proud of their role in the company as an executive to leave the company. The banks know what they're doing. The banks understand our human nature. The banks have been doing this since the 1600s when the first systems were kind of put in place with notes and different things. And so one of these golden handcuffs is the executive bonus plan, split dollar arrangements. It's when the banks put a policy but allows the employee to access some of the cash value, or maybe they're going to share some of the death benefit over time if they leave before a set period. That protects maybe that person's family, maybe gives them access to things that they're going to want to buy in their life, and the bank helps them. But it's usually a portion. And if they leave, they lose that benefit. Again, handcuffed. Next is a supplemental executive retirement plan SERP. So if you have your money in different accounts and you don't have access to it, and the market goes up, it goes down, you don't know all of the different factors. Remember, we're trying to bet on just one variable. Well, this bank fund executive retirement plan using whole life, the longer the executive stays, the more they earn, the more guarantees they have, the more tax-free cash that they're going to have later on. And then they have the death benefit incentives, right? Some banks share a portion of the policy's death benefit with the executive families. Others, maybe it's another way to keep the employee with the company, but maybe they don't share. This depends on what you're able to negotiate and maybe how fair that bank is. And then your cash value access, executives may be able to tap into that cash value for personal, professional use, maybe for personal development stuff, making the total compensation package seem far more attractive. So it's a win-win for the banks. In some ways, it's a win-win for the employee as well, except now they're committing more of their most precious resource, their time, their energy, their focus to do the bank's mission. Because the bank said, hey, you can do this, and the longer you stay, the more that we will help you because they're using something that's guaranteed to get better every single day, no matter what. You can't do anything about it. So let's put it this way. If banks, the institutions that literally run our financial world, are choosing permanent whole life insurance as their safest, most profitable way or money storage vehicle, why aren't we? Why aren't people lined up at my door and all the other mentors' doors saying, hey, I have to do this? Banks have already done the research. They've crunched the numbers. They've tested the strategy. They went through litigation or they went through the legal loopholes of all this, if there is any. So why not take the same playbook? Remember, success leaves clues is what Tony Robbins taught us. So why not use their plan to build our financial security? I don't know an answer that would tell you why you wouldn't do it, but just give you some perspective on what the economy looks like, what the vulnerabilities are in the economy, and what the banks are literally doing with their tier one money. So, what's it look like to now that banks have cracked the code on stable growth, tax advantages, long term wealth preservation? Remember the first principle in R. Nelson Nash's world? Think long term or long range thinking. And here's the thing, you don't have to be a massive institution. You don't have to be a multi-billion-dollar bank or institution to use this strategy. Whether you're a business owner, a family who wants to build generational wealth, an individual who wants safe, private, and guaranteed. You don't want our uncle to be involved in all your decisions, all your future. You don't want him sneaking in and going, Shane, awesome job growing that money. But hey, I need mine. I wasn't very I just wasn't very responsible the last years, and my debt just kept going up. And I just thought, hey, if I create more debt and just kept being powerful, then things would work out. I didn't really have a plan beyond that. Like I thought debt was the same as money or whatever they're thinking. I don't understand it. I'm not an economist, so maybe someone that was an economist could come and enlighten me a little bit. But the bully strategy works the same way for you with the same opportunity for you, but just at a smaller scale. And so, my takeaways for you as we went through this was, well, let's think about the why. Let's just make it super simple. Let's think about the why. Why would banks spend the majority of their tier one money purchasing permanent whole life insurance? Holy mackerel, that is boring. Whole life. Most people would run, leave the room, but you guys are all loyal followers, learners of this. People maybe are a little bit newer than others. We got seasoned veterans here who have went from debt to cash flow. We've got people who are brand new seeing this for the first time. But permanent whole life insurance, really, Jason? That's what you want to talk to us about? You want to talk to us about B.O.L.I? Something that sounds like I need to go to the doctor and get an antibiotic for it? Man, you're whack, dude. You what are you smoking? Right? Well, hey, the banks have shown us by 4xing the amount, by going, when I started teaching that chart I showed you today, when I started teaching that less than a year and a half ago, they were at $180 billion in permanent whole life insurance. Today, it's 225 billion. And that was 2 quarters ago. So it's a lot more than that in that period of time. And then understanding the tax advantages. Remember what Einstein said, you have to understand what? The rules of the game. And when we understand the rules of the game, guess what? One, we can play because we know the rules. And two, we have the opportunity to always get better and maybe play better than everyone else. Or maybe we can do something even more brilliant by helping more people and sharing this message. So next time, bring a friend, bring someone else. They're all going to tell you you're crazy, but do you really care? It's not going to hurt you. Invite them on the Founding Fathers Financial Freedom Tour. Invite them on our bus. It's a big ass bus. Bring as many people as you want and apply this to your life. Like we talk about train, teach, test. Training is the learning. You're training right now with me, with each other in the chat. training. Testing is doing. You have peers here that are doing this. You have me that is doing this. You have other money mentors, other people. This is a blue ocean. We've helped 18,000 plus families do this already. And that isn't even close to 10 million. That isn't even close to 10% of the working population to really bring back banking to the you and me level, to when this really catches on. We are at the tip of what this is going to be in the future. So again, when you're here with me, whether we're going through the black belt boot camp, whether we're talking about money meetings, whether we're talking about infinite banking and how it applies to everything that you're going to finance, because the reality is you finance everything you buy. You either pay interest or you earn interest. And if you pay cash, you will never earn money on that money again. You give up the opportunity of that money doing something for you. As you go through this, you can do a number of things. Go back, learn more, keep training. Keep learning. Then make a note, make a takeaway, do something with the information you're learning today. Go read something, learn something, look at your numbers, weigh in, analyze your current strategy. If you're putting money, here's 4 questions for you. I want you guys to answer this in the chat. Maybe Drew, if you're still here, or Shane, or someone answer these in the chat. We talked about science. We talked about math. We talked about variables. We talked about 5th grade or 8th grade science and having a hypothesis and needing to go prove it. How many variables do we want to have? 1. Let's look at the future of a qualified plan, whether it is a 401k or a Roth or any other government-sponsored qualified plan where you have Uncle Sam as your partner. Let's just ask a couple questions. Does anyone here, other than Gary Brecka and the whole life companies, know how long that we're going to live? How long you're going to live? No. Maybe you have an idea. Maybe you have a wish, but you don't know for sure. That's 1 variable. Number 2, do you know what inflation will look like when you decide to stop doing what you're currently doing and want to kind of retire, if you will, or kind of take it easy or do some of the other things for that part of your life, like some of you here are wanting to do? No, you have no idea. Do you know what taxes are going to be in the future? We have a good guess that they're going to be higher, but we don't know what they're going to be. We don't know Uncle Sam's going to sidle in and be like, hey, man, pay up. Let's go. Give me my money. And then a 4th one is, do we know what the market's going to look like? And I'm sure you guys are super smart. You guys are invested in learning this. You could tell me more variables. That's 4. Isn't this like being a kid and putting a blindfold on and spinning around and trying to, pin the tail on the donkey? And you're like going and you're like, I pinned on Bobby's head. Bobby's bleeding. What do I do? Right? I mean, it's that crazy. But do we ever stop and think about that? Do we ever stop and think about that? So as always, super blessed to have all of you here. I'm going to pop this in the chat. Next week, I have an idea to do something special, but I haven't talked to the individual to see if they'll do something special with me. She might be listening right now. You might know who I'm talking about. But either way, keep learning, keep applying, and keep sharing the invitation to come on the Infinite Banking Bus. I'm super blessed to have all you here. Thank you, Jeanette. Thank you, everyone, for participating. B.O.L.I, it's not something you need to go to the doctor for. It's something that banks are keeping all of their tier 1, their stable money in, to the tune of $225 billion, 4xing the amount of bank-owned life insurance. Google this, check it. Don't believe me. Go research for yourself, think for yourself, learn yourself. I'm so blessed to share this. You guys are unlike most people. You are the 5%, giving your time, your energy, your most precious resources to be here. And now you know how you can use what the banks have vetted for us. What the banks have paid probably millions of dollars to make sure that it was as stable and guaranteed as it's advertised to be. And so I'm just inviting all of you, why not learn more? Why not apply this to your life? If you're someone who earns enough and you save and you have lazy money, join this because you're going to finance things in your life. So learn how, book a call with me. If you're new here, go ahead and subscribe to the channel, smash the like button and ring the bell because it might just turn blue and you'll be alerted to all my new content. And I'm going to see you guys in this next video right here, where we keep going deeper and deeper into the infinite banking process, keeping it super simple. That is my promise. Keep it simple like a 5th grade level. Are we smarter than 5th graders? I'm telling you right now, in God's world, things have to be simple, plain, and easy to understand. And when we know that aligns with the truth, guess what? Anything's possible. So stay blessed, be blessed, and I'll see you guys on the next video.